I know we're attractive. There's no question. Those two projects are one project. It wasn't just about buying ounces anywhere. It was about buying quality ounces that were strategic to the master plan where we think we can take Orefinders.
But give me more detail on that. Okay, so what is it that you're trying to build in the next 12 months other than some drill results on those two assets, which will tell people that you've made the right decisions, you've picked the right assets? Hello and welcome to Crux Investor. First of all, thanks so much for watching this video. If you like it, give us a thumbs up and do leave your comments below. It just really helps us understand the kinds of questions you want us to be asking, your thoughts on the company, and generally the sorts of information that you'd like us to seek out when speaking to these companies. If you haven't already done so, please click the button in the corner of the screen to subscribe to our YouTube channel. And of course, for more videos like this, click the notification bell. We spoke earlier today to Stephen Stewart, CEO of Orefinders. They're an explorer in the Abitibi region, also put together a portfolio of companies, 4 to be precise. They're looking to develop a couple of those with what money they have. They've got about $2 million in the bank at the moment. That should allow them to do a drill program for the next 12 months or so. We'll see what they end up with there. Eric Sprott has placed a bet with them. He picked up about $1 million of the recent private placement. We talked to them about their business plan and how they have picked up these assets cheaply with paper while the market was downturned, and they look to try and monetize those for shareholders. Quite a robust business plan, quite like what Stephen had to say. Wonder if you do too, so let us know what you think. Take a look in the description below at any of the topics we discussed. Anything that interests you in particular, you can click on that timestamp. I'll take you to that part of the video. So let's hear what Stephen had to say. Hey Stephen, how are you doing, sir?
Doing very well. Thank you very much for taking the time.
No, pleasure. Nice to meet you for the first time and get to hear your story. Why don't we kick off with a 1-minute summary for people new to this, and we'll pick it up from there.
Sure. Orefinders is listed on the Toronto Venture Exchange. We're exclusively focused in the Abitibi, particularly in Ontario. We were born 2013. I took over 2015, and ever since then, we've really had a different business model, which is to buy on the down, and when the market turns and it appears we're at the beginning and potentially at the first inning of a 9-inning game, we would pivot towards exploration. So over those, since 2015, we've accumulated 6 different assets. Some are physical properties, other equity positions. And going forward, we're going to be investing in those properties as opposed to acquiring.
Okay, great. Thanks for that summary. You mentioned a phrase there which dear to my heart, was this, business plan. Okay, I have not seen yet a company in the mining space write a business plan, which is extraordinary from when you're coming from outside of this space. You've got the semblance of one though, because I spotted a document which you guys wrote in 2018, which talks about why invest in Orefinders. I'm interested in the non-generic pieces. I'm interested in the bits where you talk about what you're going to try and do. You've mentioned a slightly contrarian attitude in terms of, where you are in the market determines the actions which you take. So can you take us through what it is that you set out to do when you came in 2015, please, and has that changed?
Well, when I came in 2015, the share price was half a penny and there was about $200,000 in the bank. The traditional model of drill, take out a resource, and what we had, 500,000 ounces. We see multi-million ounce potential on that asset, but that just wasn't feasible in that environment. And so what we did then is we revived the company. We did a starter pit on what's called the Mirado Project. We generated a little bit of cash, and that brought us from basically a dead company in a tough market. It was through no fault of previous management, but it gave us a heartbeat, and we same time looked around and figured out real quickly that that's not going to fly going forward, and let's capitalize on the other companies who are like Orefinders that have great assets but don't have the capital to deploy it. And even if they did have the capital, it was our belief that nobody was paying attention. So you could spend $1 million on a drill program, you could exceed investors' expectations, but they'd use it as a liquidity event, and that's not a very good investment proposition. So we took that and decided to buy other Orefinders, so to speak. And that's what we've done quite successfully since 2015.
Okay, but the game plan being what? To build up a portfolio of these assets, which you can then do some work on to decide which ones you focus on, which ones you farm out. Tell us a bit more about what you're actually trying to do in terms of monetization of that model. What does that look
Fair
like?
enough. No, so the idea was to buy quality ounces in the ground, not just random projects, but projects that were very, very strategic and geographically proximate to us. On that, when we had that one asset called the Mirado, the idea was to build a mill there, and are there other assets that we could, in theory, truck to and create a hub and spoke model. So we've really stuck to that idea. Again, you're right. It wasn't just about buying ounces anywhere. It was about buying quality ounces that were strategic to the master plan, where we think we can take Orefinders.
But give me more detail on that. Okay, so what were the profiles that you're looking for? I know you're focused on Abitibi, which is great. You're surrounded by some great big names there. But given you don't have a lot of money, given you're relatively new to the space, and the track record, which we'll talk about in a second, is there's a lot of competition for the good stuff. So what were you able to hone in on? What were you able to acquire, given the restrictions you found yourself in?
So it has to have access to infrastructure. If it's on the road, if it's in a call it a 20, 30 kilometer radius, as much data, we're big on data. So we wanted to buy people's drill programs of yesteryear. As you know, in this market, it's highly cyclical. So you can have a hot drill program and people chase it up, the company to $1 or so, but then 2 years later in a down market, it's available for pennies on the dollar. So that's what we did. It was really about buying work that had been completed, that we have the data, not only the data, but the core, so we can reevaluate it ourselves and build our portfolio that way. So it's about replacement costs and building as much value in that sense as we possibly could, so that when we pivot, and we're in the pivot phase right now, we have a great asset base, and then we can go out and raise money at a much lower cost of capital, which we're slowly but surely getting there, and then reinvest based on the information that we know about these projects that we acquired.
Okay, so again, just help me out here. So it's quite a competitive environment. You're saying we did it in the time when no one was interested because it was in a down market. So we're picking up good value, low cost projects. What did the data tell you? Because I presumably these are either old mines or old workings, which the data tells you something. So what were you looking for?
We're looking for, resource size. A lot of these projects, some of them did have 43-101s on them, but we, don't ascribe a lot of value to other people's 43-101s. It's really about high grade, surface resources, anything that we see has potential. Again, if you're on the Abitibi on these major breaks and there's gold in the system, and we don't see any fatal flaws, we see value. And while I say nobody was interested, I was talking about the retail guys. And so the retail investors weren't typically interested. But there certainly was a lot of competition on to acquire the assets from competitors like Orefinders. And so that said, we didn't go for the obvious candidates. We looked for unique situations. For example, we acquired our McGarry project, and that was from a company called Crux, who faced financial difficulties because they went into production, and small scale mining, production, more often than not doesn't work out. And so we picked up the pieces there. And so we paid $1 million in shares for an asset that had tens and tens of millions of dollars worth on it. And we wouldn't have been able to execute on that had Kerr been focused, but they decided to leave Ontario and go to Arizona. Same thing with our Mustango acquisition that we did. It's not an acquisition, but we did a proxy battle. Again, that was a unique situation. So we couldn't afford to pay top dollar on top projects that everybody wanted. We sought out problems that we felt we could fix and that would have significantly greater value in a different market.
Got it. Okay, so you're prepared to pick up projects with a little bit of hair on them because you're prepared to put in the work to fix those problems.
Absolutely. Well, they all have hair to one degree or another, but yeah, we like problems, and so we get in there and we do our due diligence, and if we can fix it, great. If I can sort of extrapolate a little bit more on the McGarry, that project when we acquired it, so there's a whole slew of people along that trend. It's right on the Cadillac trend. It's contiguous to the Kerr mine, which was one of Canada's most profitable gold mines. mine. So in terms of a closology play, it was hot. However, it had significant environmental work orders against it. It had corporate litigation tied up. Basically, for the last 20 years, it was just, wasn't going anywhere. And so what we did is we optioned it from Kerr, the company that I said, and we had 9 months to figure out the situation. So it was intense negotiation with the Ontario government to find a solution. Hey, we're willing to take on these problems. We're willing to, monitor the environmental situation, but you got to get rid of all the hair. Work with us here. And so the government did that. And we did the same approach with the private litigation. And so once we solved those problems, we closed on the option. Had those problems not been there, there's no way we would have been able to acquire the project at $1 million. No way.
Okay, so let's describe a couple of those scenarios. So that's McGarry, Mustango. That was a different sort of problem, right? So
yes.
You guys from May last year through to pretty much the end of last year were in a bit of a legal dispute, and there were some games from both sides. Why was it an antagonistic scenario here? What had happened?
Well, plain and simple, we were looking to get rid of the board and the management who we felt were not doing right by shareholders. Plain and simple. The genesis of that, and you're right, that was a very different approach. It was adversarial. We approached them in a friendly way and said, come into the fold. And they said, sure, it's worth X, but the X, I assure you, was not a fair market value. It was unrealistic. And so we looked at their shareholder registry and found that Osisko Gold Royalties was the largest shareholder. They had 31%. We approached Sean and company and said, would you rather be a shareholder in? We had developed somewhat of a relationship with the Osisko guys by that point. And they said, sure, go for it. We've been looking at this and wanting to do something, but they did, they're a multi-billion-dollar company. They don't have time to get down in the trenches and do what a junior is supposed to do. So we became the 31% shareholder, and quickly thereafter launched a proxy battle, which resulted in, public back and forth, which isn't all that unusual. We had 2 AGMs, which we won both of them, but they were, just because you win an AGM doesn't mean you win an AGM, if you know what I mean. And so, litigation was involved, and, it got messy, but it was so worth it, because the asset that the company has, it's got the original asset we went after was the Omega, and the Omega is very proximate to, it actually splits our Mirado project, the one I talked to you about 2013, and it splits the McGarry. It's right in between. It's got nearly 600,000 ounces of decent grade near surface, right on the Cadillac. It's a nice asset. And then when we got in there and we pulled the company apart, we saw that it had the Ebby Baldwin, which was a huge land package right next to Kirkland Lakes Macassa, which is Canada's highest grade gold mine. So that really, paid off for us.
Okay, so that's interesting. It tells me a lot about your character and the character of the team. So you're picking up these old mines or assets. But what are you going to do with them? Are you looking to build them out and then attract whoever the next door neighbor is, or can you piece this kind of organic jigsaw puzzle together yourself to create wealth by joining them up? I mean, what are you thinking here?
Well, first and foremost, I'll be very clear. We don't have an intention of building a mine. I'm not a mine operator. I'm in the business of making money for my shareholders. And if I were to build a mine for the first time, I assure you it wouldn't do a good job. There are a few examples of people who switched from resource developers and explorers to miners. Osisko would be one example. They did a great job. Good for them. We're not really willing to undertake that risk. I think where our skills lie are in sniffing out overlooked opportunities. Getting deep into the data and recognize geological opportunities, and being the 10th person on the project and realizing them, not necessarily the mistakes, but understanding something that maybe they miss and taking a different interpretation on that. And so we put those opportunities together. We certainly are interested in taking it to the next level, because all of the projects we buy here, none of them are ready to go into production. None of them. They're all exploration projects to one degree or another. And so we're also looking for that, the Lassonde $1 billion drill hole. I mean, ultimately, that's the big score. And we think by putting ourselves in jurisdictions like the Abitibi, on the Cadillac, on the main break, beside the Macassa, beside the Addison, that increases our odds. I mean, the odds are still stacked against us, just because that's the Mother Nature's trick. But that's the ultimate score, is to find that discovery drill hole, drill it out, and then look for somebody who would be better at building the mine. But look, who's our neighbor? Kirkland Lake Gold, Agnico Eagle. Those guys are pretty good at what they do, and we're their neighbors. It's I also have if you go on our website, I also am very clear about how I see M&A as an absolute inevitability in this industry. And while we are an acquirer right now, I think there will be a time when we become the acquiree.
Well, you've also got to start doing some work. Okay, so we're looking
Absolutely.
at your share price, 14 million today. You've had a good month or so. It was about 8 million up until recently. So not very big. You've got a bunch of assets. You're going to need to raise some more money and spend some money to develop these to a stage where you can have those sorts of conversations. So talk to me about that. How much cash have you got today?
We got about $2 million in the bank. We just recently completed a financing where Eric Sprott came in. He was $1 million of that, and then people around him and others topped that up to $2 million. So that's give or take our cash position. We have equities in our portfolio companies, which are not for sale, but they're sort of quote unquote marketable securities. When the time is right, we'll certainly sell them, but it's not today. We have enough money, for the next 12 months, no problem.
To do
so we're
what?
not in a position
But to do what?
To drill out. So our next move is going to be inwards. So we're going to be drilling on our Knight project.
Okay.
Knight and Shining Armor, which is actually about 70 kilometers to the west of the properties we've been talking about. We've got 3 styles of mineralization that we're focused on. So that is in the near term. In fact, if it wasn't for this virus situation, we'd probably be on the ground as we speak, but we pulled back. And then the second drill program we're going to be doing is on our McGarry project, which is contiguous to the Addison. So we have 2 drill programs in the pipeline that you'll see us complete in 2020.
Why those 2 first?
Knight project was the one that we advertised before we did any financing with Mr. Sprott. We were that was where we feel we're going to get the best bang for the buck. We've got 3 different targets. One is a binary big, what we think is a porphyry system right near the surface. We'll poke one hole in that. It is or it isn't. We've got a whole series of breccia pipes, one of which has been drilled out. We have incredible drill results, 18 grams over 65 meters, 13 grams over 80 plus meters in a pipe. We think we've identified a whole series, a little, a carrot garden, if you will, that we're going to go test those. And then we've got our Tiranite mine, which again is on our Knight project. And we've got a different interpretation of how we're going to drill that. So we think we had originally budgeted $500,000. That gets us about 4,000 meters. That'll be, that's a 60 to 90 day drill program. We've already got 30,000 meters of drill core from previous owners on that project, which we compiled and re-assayed. That will go into the project's 43-101. It's the only project that we own that does not have a 43-101. That project sits on top of a 4 million ounce asset owned by Pan American Silver, who are in the process of transacting it to it. I have a pretty good idea. In fact, I know who has purchased it. It'll be very positive when that news is released. It's the group that's buying it is going to invest in it. That 4 million ounce asset that we are contiguous to hasn't seen any investment in 10 years. And the best part of it is that this company coming in, if I'm right, and I'm pretty sure that I am, they've got a real balance sheet. Okay, and so they're going to come in there and systematically invest in the Juby, which is 4 million ounces. But as I said, just like all of our projects, the Juby's not ready to go into production. It requires significant investment. So significant investment is good for the regions, good for us. And again, I think our Knight project goes hand in hand with the Juby project. So I'm always thinking about consolidation, putting things together, putting the pieces together. It doesn't have to be us, but we have to make money as a part of the group.
Okay, that's okay. Again, you give us some clues as to the strategy, the chess moves you're making here. So $500,000 on top of existing data, you put that together and you think you can be attractive to someone next door, potentially, if you're on the same structure.
I know we're attractive. There's no question. Those two projects are one project. You know, they've got the low grade, we got the high grade, and we've got a lot of exploration potential. So it's a function of time, price, terms. And you know, those I can't speak to. I'd be speculating beyond that. But I know very well that those two projects belong together. We had an interest in the Juby, no question. We went after it, but it didn't work out. We've gone after it many times through its owners, whether it was Pan American Silver, Temex, Lakeshore, etc. We've always been after it because it's an important piece of the puzzle. So, so that will be, I anticipate a transaction on that asset there. That obviously has no direct implications on our business, but we are absolutely doing a drill program there that bring more eyes to the story.
Okay, so tell me about McGarry. What's the chess move on that?
So the chess move on that is why we're drilling there is, again, the Crux, which is was Canada's most profitable mine for a long time, 11 million ounces. What has happened there is that there is a private group out of New York who owns it. They're reinterpreting the geology, so they're looking at putting an open pit on that project. It's a very sizable resource. Again, it's a private company, so this, you know, I won't talk too much about the details, but it's a fact. And that is going to be transacted upon at some point in time. Now, whether that's, you know, next week or next year, I can't tell you, but I can tell you they got a substantial resource. I can tell you that we also own the property next door, which has same geology, same stratigraphy. We've drilled it. We did an exploration program on it, you know, without drilling on the fall. We got great results. We're going to be drilling that in short term. So in the coming weeks, you'll see us come out with a press release with a detailed plan for how we're going to drill that. Then the second bonus on that news, if a major comes in and takes out the Crux, is that we own the tailings facility. So remember when I said we optioned that property from Kerr Mines, part of the environmental issues was the tailings facility. Sometimes you want a tailings facility, sometimes you don't. When you're looking at a brownfields environment with a project next door that is going to need a tailings facility, considering the price we paid for it and the position that puts us in for whoever ultimately does take it out and develop it. Again, it's not going to go into production next year. It needs work. But we're very much a part of that piece of that puzzle.
Okay, so that's how much is that? Another $500,000? What are you throwing at that?
Yeah, well, we haven't come out with the details there, but sure, $500,000 wouldn't be unreasonable in
right.
terms. I mean, we can drill super cheap because we're on the road. We drill last drill program we did was $62 a meter. Obviously, there's ancillary costs, but it's very, very cost effective.
Okay, so you've got $1 million left. Are you gonna touch Mirado, Amiga? You've got nothing really do at Mustango?
There are no current plans to drill out Mirado. Absolutely, we want to. It's a function of capital, right? We don't want to get
that's what I'm getting
too ahead of ourselves.
That's what I'm getting to.
So, you know, yeah, okay, go ahead.
No, I'm going to say, so, you know, you're looking at two of the assets. You're going to spend $1 million on those. You hope to be able to build on what you already know about them to make them attractive to who? Next door, perhaps the people next door, or perhaps you've got to raise some more money and spend a bit more money to make them a little bit more attractive, slap on the lipstick. So at what point are you going to be having those conversations about the next fundraise?
Well, I can't tell you, to be honest with you. The only thing I can tell you is that we don't need the money right now. We are very cognizant of our cost of capital. So, you know, as I said, we can execute on those two programs and keep our G&A, which is fairly modest. We're good for 12 months, no problem.
But you don't find
if there was an opportunity.
Do you not feel that the market gets nervous when companies are getting into the hundreds of thousands of dollars in reserve? People get very, very nervous because you're kind of cutting it fine there. So I appreciate you look after your money, and I appreciate there's a plan, and I appreciate you've got a business plan, and you know I like that. But and Eric Sprott has joined, but he spreads his bets far and wide. There's lots of bets placed by Eric Sprott. How do you make this attractive enough to attract not just the retail investors for liquidity, but Eric Sprott? How do you persuade him to put the next tranche of money in? You know, you must have had that conversation when they put their money in, and others. What is it that you're trying to build in the next 12 months other than some drill results on those two assets, which will tell people that you've made the right decisions, you've picked the right assets?
Well, I think the results are going to have to speak for themselves going forward. think in the past, it's called the past 12, 24, 36 months, is about building that portfolio. Going forward, as we said in our business plan, it's about pivoting towards investment in their properties and exploration. We are explorationists at heart. And so the drill results are going to have to speak for it. If we drill dusters, well, it's going to make our lives more difficult for sure. If we are successful and the market is receptive to successful drill results, where they haven't necessarily been as of late, but that's changing, then I suspect we'll have absolutely no problems raising money. I think what I bring to the table here is my network, and we've got a very good established relationship with them. We've got a Cisco shareholders, we've got Eric Sprott, we have very good shareholders. We've never had a problem raising money. The problem has always been at what cost. And so to me, that's the question. It's not can we raise money, it's at what cost. And that, is me predicting the future. I can't tell you that. Obviously, I'd love to. I mean, Orefinders, when we went public, we were a 50-cent share. Okay, and we just owned the Mirado. So, that speaks to how powerful a strong junior market can be. I mean, we're worth a fraction of what we were when we owned one of 6 assets that hadn't even been drilled out. So, again, we're not, hope is not a strategy. So we're not waiting for the gold price to go through the roof. But if it does, and in combination with successful drill programs, we'll be in a very good situation. If we miss, we'll have to evaluate our situation and we'll make decisions then.
But again, one asset with some cash, people feel you might be able to do something on that, and people, are happy with a single assets strategy. Multiple assets, to me, reads like multiple liabilities, because you need the cash to be able to do something with them. They're just an overhead, quite frankly, until you can do something. So your drill program is what you're banking on over the next 12 months or for the rest of this year to define the fortunes of the company going forward.
No, I wouldn't say that's too binary. And I would say one thing, that no, our assets are not liabilities. I'd rather have 100 assets than one asset any day of the week, provided they don't have a drag. All of our properties, certainly the vast majority, the core holdings of these properties are patents. Okay? And so there are no work commitments that we have to meet. There are very, very modest taxes. We're talking the order of $10,000 a year to keep these, and we own them in perpetuity. So us acquiring them and holding them forever is no problem. And so there is no pressure for us to spend money. We can if everything goes to a handbag, so to speak, we put it on the shelf and we wait. So we have the ability to be patient. That's been, and maybe I should have said that off the top. We absolutely don't want to acquire 1 million hectares of land that requires every 2 years we got to spend $10 million. No, well that's a failing business model in the juniors, especially as a tough market like this. So part of our criteria, and that's been, I guess, an added bonus, is when you acquire these former producing mines and projects that had 10,000, 50,000 meters, they're either patents or they've got a lot of reserve. So we have, time is on our side. And in terms of living and dying on the drill program, no. I disagree with that. I think that's upside, no down. Is there downside? Sure, we'll sell off if we drill some dusters. That's the way it is. But we'll come back. We'll make another smart deal. We'll sort it out. My job is to deal with problems, and we've faced all sorts of problems. I think the investing public understands the risk associated with the drill program. People are disappointed if it doesn't work out, but hey, we're optimists, and it's not like we're drill testing blue sky here. We're we're drilling in the Abitibi on the Cadillac break. We're going to hit some gold. The question is, do we hit skinny zones? Do we hit wide zones? How rich is the grade? So, the risk on exploration is mitigated to one degree or another. But that said, this is a risky business.
How are you remunerating yourself?
$10,000 a month.
Shares, options?
I own 5 million shares. It's got a 4 in it, but it's a high 4. Not a single one of those was free. Okay, so I bought every single share in the market or at a private placement. Options, I haven't done the math on the options, but I got a couple million options at least, something like that. I think we have a rolling 10% plan, which is pretty standard. I think at the time we probably have 6 to 7% outstanding, so there'll probably be another option issue in the not too distant future. We didn't want to do that right away. We had, when we did a financing with Mr. Sprott, our share count went up. We could have issued options, but we decided to wait because it wasn't the right time because of the COVID situation. But that's largely how I remunerate our team, as options. we're in the business to make money, just like our shareholders. We don't sell our shares. Okay, so if you see us sell our shares, probably retail should sell too. I'd say our team, our director team, call it insiders, have probably about 20% of the company. I would say another 20% are held people close to us. Our core investors. That doesn't include Mr. Sprott, but he's new to this story, and then we've got 5%, probably not 4% is Cisco. The rest is float.
Okay, and what's your G&A monthly?
Monthly, well, I think annually probably $450 with nothing going.
Okay.
So with drills spinning, that's everything, and obviously that ebbs and flows. So I would say if you probably go our trailing 12 months, it's probably more than that because we had the Mustango situation, so our legal bills were higher. But then you have to evaluate, when we got into Mustango, we bought our shares at 2 cents. Now they're at 18. So we probably spent a couple $100,000 to the lawyers, which hurt, especially at the time. But it's paid for it in spades. And in fact, I think Mustango is worth many multiples of 18 cents. So, that will pay off.
Was that a distraction for you? Did you feel Mustango could have been handled differently?
Well, it was a distraction. Absolutely. It was a stressful, intense 6 months for sure, but it was more than 6 months because it took 6 months to line it up and get all the pieces organized. But yeah, dealing with the courts, there was a lot of times where it could have gone the other way easily. We won 2 shareholder votes overwhelmingly, yet they just refused to acknowledge it. And so then the onus is on us to go to the courts and say, Your Honor, this is what's happening. And so, those were risks. And, but yeah, it's no different than, I would say the risk profile is on par with, drilling a drill hole.
Okay.
Maybe less so.
Okay. Would you go through that route again?
It depends. I wouldn't rush to it. I'm enjoying, not having to go to court and not having to, deal with all these lawyers. So in that respect, but sure, if the opportunity presented itself and we were properly financed and the opportunity was there, when we saw Mustango, to us, it was obvious. The value proposition was obvious. This company was trading at $1 million and it had fantastic assets, and the management team was not doing anything, like literally nothing. So we knew that had we, and I think we have a pretty good following, and I think we've got a pretty good reputation, both technically and how we manage our companies. And so I knew I could convince their float to say, hey, just like I did with Cisco, who would you rather in control? And overwhelmingly, it was the only people that voted for them were them. It was obvious, and they hadn't done a press release in 6 years. And so if we identified, and believe me, I have a list of companies. But it's a question of opportunity, time, and getting the proper financing in place to do that. Because that was, I don't want to say that was an easy one, but that was a small fish. There are a handful of companies that I've identified that have a $40 million market cap, $20 million market cap, who could mount a more formidable legal opposition. And believe me, it is complicated. So you need to be properly financed. But yeah, look, there's a lot of bad management teams in this industry. I think you know that.
Oh yeah.
And so there's a huge opportunity there, but it's a bit of a different business model. So
okay, so you've been here since 2015. The market's changed in the last 9 months ish. Since August, it's got a lot better. We're in a rising bull market. Do you think that? And I like your strategy. Okay, I do like that. Do you think you've got the energy to go to market and ask for more money to do more of what you have been doing? You've got a list of targets, you told me. Why don't you do that?
Because I just did a financing, and I just did it, less than a month ago.
That's for different. That's a different outlet. That was right. I'm going to try and monetize some of the couple of the 4 assets I've got. But you tell me there's more targets out there. You've got a list. Oh,
you're talking about to go and do hostile takeovers or proxy battles?
You tell me you're good at it.
That's I didn't say I was good at it. I said I was successful in the one time I've done it. And I said it very clearly. It could have gone the other way. And had we not been incredibly persistent, it required a whole team effort. Had we not been 100%, 110% committed, we would have lost. So I am not, let me be clear, that is not Orefinders' business model going forward. I much prefer friendly deals, but if we cannot do a friendly deal, we're certainly going to evaluate it. If I was a big hedge fund manager, like I'm talking hypotheticals here, and I had 100 million behind me, and put the right team together, yeah, I'll tell you exactly who we go after. Well, maybe off record, but there's no shortage of opportunities because we spend a lot of time looking at our competitors, whether that is asset based or corporate based, and we try to do deals. We knock on a lot of doors, and it doesn't always work out. And I say, well, that guy's not, or gal is not, paying attention and doing it right by their shareholders, and most shareholders would agree.
So I'll finish off now because you've given me a lot of your time today. So what is it that Eric Sprott bought into? If it wasn't the strategy, was he buying into your ability to monetize Knight or McGarry, or was he buying into your strategy of buying up these older mines and doing something with them down the line? So why did he give you $1 million? Why didn't he give you 10 million?
Well, because we wouldn't have taken it. First of all, it's a function of cost of capital. Why did he come into Orefinders? Well, you'd have to ask him, but I'll give you my 2 cents. All of the above. I mean, I think he does a holistic approach. And, yes, you said he spreads his bet far and wide, but take my word for it, he doesn't, do it without his due diligence. Eric is sharp, okay? Sharp as they come. He's successful for a reason. And it didn't happen overnight. It took a lot of, tactfully approaching Mr. Sprott and convincing him of who we are. He monitored our progress on Mustango and how we took that out. I think that, showed a certain level of corporate confidence. And let's face it, our assets, whether they are Mustango or Orefinders, are centered in and around Kirkland Lake, okay? And I think he's done pretty well in that area. And many people don't appreciate is that the Kirkland Lake gold, call it the Macassa, that is the 3rd largest gold ore body ever mined. And it's a single ore body, and it's not just the Macassa. In fact, it's 7 mines that have happened over different eras, but it's a single ore body. And we're on strike to it, to the east of it, to the west of it, to the south of it. There are other ore bodies in Kirkland Lake, and whether it's a part of call it the big mother ore body or a derivative of it, there are other ore bodies there, and we've got a great land position. So I think he likes our area. I think he likes our team, and he's taking a shot. So good for him.
Okay. Thank you for your time today. Nice
Pleasure.
Story. I like that you've got a business plan.
Yeah, well, look, if you don't know where you're going, all roads will get there, right? So I thought it was important to, give investors and prospective investors, a general idea of how we view the market and how we plan to make money for them. Because, they may like our assets, they may like us, but really, at the end of the day, shareholders care about what they, 2 things: what they paid for the share price and what they can sell it for. And so, we had to devise a master plan of how we're going to get there. There's lots of ebbs and flows in between, but that's how we see it.
Brilliant. Stephen, thanks for your time. Stay in touch. Let us know when you start getting some news flow through. We'd love to talk to you again.
Yeah, absolutely. And keep up these interviews. They're doing a great job.